So there seemed to be some kind of herd mentality among participants in the tech firms in the Valley, where it somehow seemed to be cool to put your money with SVB. SVB was really good at getting large deposits in and was not so good at figuring out what to do with those deposits.
They only stress tested for scenarios similar to the Great Financial Crisis. And if you test for that scenario, then if you own these, treasuries, you don't make out too badly.
Machine learning methods that are used in statistics and econometrics may be incredibly helpful in some of these stress tests that, the Fed in principle has access to all the data that a bank has.
Hi, everyone. My name is Randy Xu with Lohan Academy, and I'm privileged and excited to be joined by Professor Richard Holden. Professor Holden is a professor of economics at the University of New South Wales Business School. He's the director of the Economics of Education Knowledge Hub, as well as the co-director of the New Economic Policy Initiative. He's also the president of the Academy of Social Sciences in Australia. He has way too many sort of academic publications and other credentials to name here, so we'll kind of skip that for now. But suffice to say, Professor Holden is an expert in many areas of the economy as well as the financial system. And the reason I'm excited to have Professor Holden with us today is that there's been lots of news going on about the failure of Silicon Valley Bank and several other banks, and what that kind of means for the economy and the financial system. And Richard has written an article recently in AFR, the Australian Financial Review, on this issue and touches on some of the economics of it. So we really want to kind of have a chat with the economics of the situation. But given the zeitgeist today, maybe we can start. It seems like there's a blame game, right? That's kind of already started. And certainly it's one of those situations, maybe the answer is all of the above, right? But clearly, people are blaming the bank itself for bad management. They're blaming regulators for not catching it, even though, this problem seems to be in plain sight, blaming politicians for changing the rules and the SVB for lobbying, blaming auditors, blaming the tech firms themselves for causing this crisis with their Slack channel, and then also blaming the Fed for keeping interest rates too low too long. So, walk us through this. How do you kind of separate all these issues?
Yeah, it's a great question, and great to be with you, Randy. The way I see it is, let's start with this fact, which is SVB was really good at getting large deposits in, and was not so good at figuring out what to do with those deposits, at lending them out in an effective way. So, traditional thing that a bank does, sort of two, you can break it down into two things. One is it takes short-term people with, money to deposit in the short term, and then matches it to people who have long-term needs, like people who need to buy a house and going to pay it back over 30 years, or businesses that have long-term investments to make, and so on. And we'll get to why that can create its own set of problems in a minute in and of itself. So there's that maturity transformation role that banks play. The other thing they do is they have an important informational role. And this was, something that was very much present in the work of Doug Diamond, who shared the Nobel Prize last year, that the informational role that banks have is really important, that because they have banking relationships, they're going to know more about the creditworthiness of the people that they're lending to. When they give you a mortgage, if they've banked you for a really long time, they know a lot about you. Or if they haven't, they have an incentive to find out a lot about you. And so that informational role is really important. And that maybe wasn't completely absent, but seemed to be somewhat missing with SVB. So for instance, you might think that what they were doing was, taking money from Silicon Valley depositors, from VCs, and lending it out in some other way to players in the tech industry. There was a little bit of that, but something along the lines of 43% of their lending was actually just buying long-dated US Treasury securities. Now, You don't need a lot of information or a lot of skill to be able to invest in US Treasury securities. You and I can do that. We don't need to know anything to do that. So it's sort of a slightly odd thing for a bank to be doing so much of that. And then, of course, you get this interest rate rise from the Fed, which, has been a long time coming and really, quite predictable. And that means you have to pay, SVB has to pay more to their depositors to keep the short-term money in. At the same time, because the yield on these long-dated treasury securities, these bonds, goes up, it means the value goes down. So on paper, they have a kind of solvency problem. And that wound up with them doing, and when depositors see that, they get worried about whether or not they're going to get their money back. And as depositors started to take their money out, SVB was really in a tight spot, and they sold $21 billion of treasuries at a really steep discount. So they took a $2 billion haircut on that. And once investors saw that, they basically said, well, once depositors saw that, they basically said, these guys are totally desperate, because, who sells treasuries, $21 billion of treasuries at a $2 billion haircut? These people have run out of options. And then once the bank run is on, again, Doug Diamond, perhaps his major contribution was to point out that, that just becomes a self-fulfilling prophecy at that point. I think just sort of stepping back through the sort of blame game. So SVB certainly did some stuff wrong. I think there were some depositors who were pretty naive as well. They, put their money into SVB well above the insured limit of $250,000. You got tech companies putting, in some cases, billions of dollars, putting all their eggs in, or many of their eggs in one basket there. Now, in the end, I guess they've been vindicated because they've been bailed out, but that was far from obvious that was going to happen. So there seemed to be some kind of herd mentality among participants in the tech firms in the Valley, where it somehow seemed to be cool to put your money with SVB rather than some, old school New York bank, sort of boring bank like JP Morgan Chase or something. So I think they bear some of the responsibility. And then perhaps lastly, there's certainly, as you alluded to, the fact that under the Trump administration, the threshold for stress tests of banks was raised from $50 billion to $250 billion. And so SVB could kind of fly under the radar screen in terms of not having stress tests from the Fed. I think there's also a question of how rigorous those stress tests were during the time of the Trump administration, even if they'd been administered. So I think that the Fed's, not the interest rate setting arm, but the bank regulation arm of the Fed also bears some significant responsibility.
Yeah, I think, thanks for that context. I think there's a couple of questions on my end. One is, I tend to, we always say it's kind of like a East Asian thing as well, to try to think about the system or the context and not any, individual person to blame. It seems to me that the problem you mentioned, the way I would see it if I were these banks, not just SVB, but the other banks with the same pattern, which is they served an industry that happened to be correlated with the interest rate cycle, right? So interest rates are low and they get lots of deposits. And I wonder how much of that is that they then, obviously they get a lot of deposits all in at once. They are in a very cyclical industry and a very volatile industry, and an industry that tends to be funded with equity for exactly that reason, but risk equity. And it's an industry that doesn't really take loans. Would you even make a loan to that industry? I think one could argue that in a way, if you're a crypto bank or you're a tech bank, you shouldn't be making loans to the people you know. And in fact, they would say if you buy treasuries, now long day treasury, that's another issue. But if you buy treasuries or agencies, things with no credit risk effectively, or relatively little credit risk, that is the risk management way of doing it, is that you're very good at getting deposits. You got deposits at a time from this industry that's very volatile, and then you put it into something with relatively little credit risk. Now, my question to that is, I've heard that one of the stress test issues, I'm not sure if this is true or not, but somewhere in the Twitterverse, someone said that one of the stress test issues is that they only stress tested for scenarios similar to the Great Financial Crisis. And if you test for that scenario, then if you own these, treasuries, you don't make out too badly from that, right?
Yeah, no, that's exactly right. And because, of course, in that environment, you end up, if you just play that through as a kind of simulation, you end up seeing, a big rate cut at the long end. You see quantitative easing, you see yields on these things go down and the value of them go up. So if you take that as the scenario that was going to happen and the sort of response from the Fed, then a lot of banks would look fine during that stress test. I think what this is really pointing to is that stress tests need to look at, really need to look at some fundamentals. And so things like, does this bank have an appropriate interest rate risk hedging program in place? And we'll have to wait and see the details of exactly, in the wash up, exactly what SVB was doing on that. But I think we partially know the answer, which is if they were doing a good job of hedging their interest rate risk, then this wouldn't have happened. So it's almost surely the case that they weren't doing that. And that's the kind of thing that stress tests need to look at. I think that the broader worry here is what else we don't know. So again, not to single out individuals, but Randy Quarles, who was in charge of this stuff, made plenty of public comments to the effect of we don't need to worry as much as some folks do about this kind of these stress tests and this kind of stuff. And so I think there's a real question about what else the Fed doesn't know. When we play this event back, it's so easy to explain and it seems so obvious that it's almost embarrassingly simple, yet nobody saw it coming, or the Fed at least didn't see it coming, which raises the question, well, what else haven't they seen coming? And I think, the real question is not, is there another sort of mid-sized regional bank that's got these kind of quirky features to it, but is there a much larger, more systematically connected financial institution? What about the shadow banking system? What's going on there? And I think that the big concern in many ways, or the thing that worries me, is if the Fed didn't see this coming, what else haven't they seen coming?
Yeah, I wonder, so that's actually a question on my end, because we clearly for the last 4 months had some warning signs. So I'm not a bank regulator and I'm not a banking analyst, but I do recall back in November when Silvergate Bank started to have issues. There were talk among some of my friends who I know in finance that this could be a harbinger of things to come. And then in January, when they reported a $1 billion loss from effectively the same situation, their depositors fled and they had to sell assets at a loss to what they bought it at. This problem was kind of front and center for a lot of them. I suppose at that point, it might be too late. You've already taken in all these deposits, right? You can't have a crisis of confidence. Hedging at that point might be kind of too expensive. So I suspect that might be the reason, but I wonder if maybe there's also a lot of behavioral psychology, behavioral economics that can be used here. Maybe they could have done something at that point, but people tend to underestimate or tend to wish for a more benign scenario.
Yeah, I think that the sort of behavioral story is definitely really important. That there's probably not too many chief executives of banks who really think that they're taking such a big risk that their bank is going to go belly up. It'd be sort of kind of hard to get out of bed in the morning if you thought that was what was going on. I think the other obvious point here is the moral hazard one. And I think so far authorities have dealt with, the wash up of SVB, in my view, very well, and that this lending facility that they've put in place should put paid to any other sort of banks of this size, suffering a bank run. Instead of, selling $21 billion of treasuries at a big haircut, you just borrow at, close to zero from this lending facility. And, that's a much better option. And once people know that you're doing that, they know they're going to get their money back. And you get to the diamond dip good equilibrium, the non-bank run equilibrium. Mm-hmm. But that obviously, and that seems like the right thing to do. But that obviously creates moral hazard. So right now I know that I can have a massive maturity mismatch as a bank. I don't need to hedge it, because if I get into trouble, I can just borrow for close to zero from the Fed. And so why not load up on risk? And I think, to me, one of the really interesting questions, so that sort of sounds bad, right? It sounds like this facility is engendering more moral hazard, and isn't that terrible? Yeah. To me, the interesting question is, maybe that's the best we can do, or in the language of economics, maybe that's the like optimal second best. We've got this problem that we're always going to have, and this is a way of at least preventing kind of mass contagion in the banking system, in the financial system more broadly. Maybe this is the best we can do. We got to live with some amount of moral hazard in the banking system.
Okay. When I read what was going on this weekend, it does seem like the authorities took pains to balance quite a few things, right? They want to make sure they want to protect depositors, but at the same time, still have risk for, equity holders and creditors, other kind of lenders, right? So I guess the question is, there's in some proposals way before this is that all deposits should be insured, right, to prevent bank runs. Like if any large amount of uninsured depositors will kind of lead to this equilibrium where you have a bank run. There are also arguments that, well, if you do that, banking isn't banking, right? If you cover everything. And in fact, this was even the business press. I think that former chairman Ralph Solstein of Evercore was on an interview in CNBC, and he said, well, yeah, if they do that, you wonder if at some point you have to start to regulate banks like utilities, right? Since they have no risk. How do you square these two arguments?
Yeah, I think that's exactly the trade-off, right? So, you can prevent runs by raising the $250,000 FDIC limit to infinity and say, we'll insure all deposits no matter what. And as you say, that leads you to sort of, this not really being banking, but there's being sort of no risk stuff. There is a question at what cost and whether you allow the banks to choose. So, one thing you could do is to say, well, you pick how high, how much insurance you want, basically, and we'll charge you for it. And then customers can choose what bank they go to, and shareholders can choose what banks they want to invest in. And you can invest in something that has essentially no risk, and you wouldn't expect a very high return on equity for that. It's a utility-like scenario, as you pointed out. Or if you want like a traditional risky bank with modest levels of insurance, there's returns for equity holders to make, but it might blow up. The complication, of course, in all of this is the contagion thing, which is it's very hard for regulators to credibly commit to be able to say, you made some bad choices, you're going to live with it. Now, what was very good out of this episode, I think, was that they did say to the equity holders, you made some bad choices, you're wiped out. And that's good, but it's very hard to say to depositors, you weren't paying a lot of attention to where you put your money. So, you lose 50 cents on the dollar. That's really hard to commit to. And, we saw during the financial crisis what happens. We saw with Lehman on one level what happens when, in that case, Hank Paulson decided to kind of throw an elbow and say, look, there got to be consequences for bad behavior. Well, maybe, but if you're systematically connected, then imposing that punishment, punishes the entire system, and that obviously created a whole lot of problems in and of itself. So it is a complicated story. I think the good news is that we've seen that equity holders aren't getting bailed out. That seems like an easy one and an obvious one, but it's still not obvious it was going to happen. So that's good. In terms of protecting depositors, though, you might well end up in a utility-like scenario, as you say.
Sure. And then one of the possibilities that everyone's talking about is, even with this more or less implicit guarantee, if not explicit to some extent, even with this lending facility that makes sure that no one will have liquidity crunch reasons for going bust right now. It seems like in a lot of economic models with herd psychology and organizational psychology, you can imagine that there still could be a slow motion run when, if you're the treasurer of a company, you might be asked, why have our money with a third-tier bank, right, rather than a first-tier bank? So there is some worries about consolidation in the industry. Like, why wouldn't you bank with JP Morgan? My understanding with SVB, by the way, some of the clients, not to excuse their behavior, but they did have covenants that said that they had to bank with SVB, right, if they had any kind of lending or working capital facility with them. But for everyone else now at this point, it's like, why not use JP Morgan?
Yeah, no, I think that's exactly right. And some of this is on the venture capitalists as well, who are the VC funds, who are funding these folks. And some of it's on public markets for some of these tech companies that were public, that were putting money into there. So, I think one of the key takeaways from all of this is what seem like kind of boring arrangements that are, in footnote 97 on page 175 of the financial report that accompanies the annual report with all the glossy photos. Actually, some of the detail in there is pretty important to the survival of the company and to the financial system more broadly. And, we need to pay attention to some of these seemingly boring, detailed things, because they can have pretty big system-wide effects.
So do you think, if you were to bet, do you think the U.S. ends up with much more consolidated banking sector? And it's interesting, you mentioned your article, like the in the Anglosphere, the Canada and Australia tend to have much more concentrated banking sectors.
Yeah, that's right. So, I'm Australian. Australia has a highly concentrated banking sector. So we have basically 4 major banks, and there are a few little regional banks, but it's really relatively little to speak of in terms of market share. Now, people often bemoan that fact because there's not very much competition. And so, depositors don't do very well in a system like that. And shareholders do extremely well in a system like that. So I think that's, in a sense, the trade-off. Do we want to have, a more consolidated and potentially, at least with good stress tests, potentially safer banking system, but a less competitive one? Do we want to have a somewhat more competitive banking system, which on some level is good for, good for customers, but a riskier one? And, you could sort of say, well, there's a trade-off, and there's got to, you don't want to go too far one way or too far the other way. There's got to be somewhere in the middle that's kind of a sweet spot. That may be the case, or it may be the case that, you end up saying stability is so important that I want to go pretty far, maybe not one bank, but, maybe something that looks more like Australia, where in a, $2 trillion economy, you basically have 4 big banks. Maybe that's closer to where one ends up. Okay.
Well, to use your lingo, I guess we won't have the Soho house of banks anymore. Okay. So I think the last couple of questions on my end, since we are a digital economy think tank, is it's the 3 banks that have kind of gone under the last week that are most prominent. happen to be very connected to the technology industry. Yet they've gone bankrupt for the age-old kind of problem of maturity mismatch and bank runs. So to what extent do you think technology can have a role to make banking more sound? And what do you think are the technologies that are coming on that can help with this?
It's a fabulous question. One reaction is to say that sort of, really quite radical shifts, things like, blockchain and digital currencies and things like that, which I think are coming, would do something, although it's not clear to me at all what they would have done to prevent this situation. I think in a sense, maybe data more than technology, or at least data combined with some of the modern machine learning methods that are used in statistics and econometrics by economists and computer scientists and other social scientists, may be incredibly helpful in some of these stress tests that, that the Fed in principle has access to all the data that a bank has. And banks these days have very, very rich data on exactly who they're lending to, exactly who their depositors are. And it's not so much a new technology as a well-established technology, but it's more like computing power plus data plus machine learning may well be able to do, a really superior job of stress tests. It may be that what comes out of this is that stress tests look, less like the slightly boring version of, a few accountants going in with a, green visor and a pencil and going over things, and look much more like an automated thing that's maybe happening all the time, that's raising red flags in real time. It may be that there's a kind of a new stress test technology that gets built coming out of all of this.
Yeah, I wonder if artificial intelligence, even artificial intelligence that is just pattern recognition, or will help with this, because my understanding is regulators are always overwhelmed, right, by the amount of work they have to do, and I wonder if something like that to kind of obviously there's a lot of other things going on with regulations and how people might play the system, but if you assume regulators are doing their jobs and they have the tools to do their jobs, I wonder if, to your point, data plus some amount of new AI coming out can kind of really help people identify problems and be more transparent, right? Like over the weekend, some of the news articles were arguing for or against bailout. Were saying obviously you can't expect an individual company, right, a startup, a 20-person startup where someone's only a part-time treasurer, to kind of monitor the veracity of statements by their banks. But I'm just thinking, well, what if we end up having much more technology on this?
Yeah, I think that's right. And I think we've learned from, it wouldn't be relevant for banking regulation, but it's sort of relevant for a certain point, which is we've learned from things like, GPT-3, GPT-4, and, Chat GPT, that they're bad at a bunch of things, but they're very good at pattern recognition, right? And to the extent that AI is good at prediction, or to the extent that AI is good at anything, it's good at prediction. And that's exactly what you want here, right? You want prediction. It's not about informing, not worried about causation as much. You just want to predict, is this bank likely to fail sometime soon? And so I think there's real hope for AI plus data in this space.
Okay, great. And then I guess the final set of questions is really the I wonder, it's funny, after this happened, blockchain crypto prices went up. And one of the explanations was that there were like multiple explanations. One of them is obviously the shoes have dropped. Okay, now it's time to kind of go in. The second explanation I've heard was that a lot of these cryptocurrencies, especially Bitcoin, was formed around this idea of what was like, entrust us, we trust, right? So they tend to have value when you don't trust anything. if you actually trust intermediaries, they may have less value. So in a way, that was kind of no surprise that in this situation, they're maybe the one you tend to trust relatively more. And then, there's obviously on a separate vein, talk of CDBCs. I wonder how, that would have changed the situation. Like if you have a CDBC, you have the ultimate central authority you can trust. And if you have a CDBC without limits, would you end up having a bank run where you go to a CDBC?
Yeah, it's a great question. I think in terms of crypto, it's sort of a little ironic, right? That Bitcoin was born, cryptocurrencies were born out of the 2008 financial crisis. So maybe there's a little bit of like, aha, we remember what the original purpose of this stuff was for, notwithstanding all the issues we've seen with cryptocurrencies in the last couple of years. In terms of a central bank digital currency, I think this is one of the ongoing and really interesting debates. I think there will be central bank digital currencies. There are some, and there are some trials and so on, or maybe rollouts in some cases more than trials. But there's a broad spectrum of possibilities of what that could look like, from a kind of really a plumbing of the payment system type, so-called wholesale central bank digital currency, all the way through to something that looks like a so-called retail central bank digital currency. And some people, not me, but some people even propose, in the US, say, everyone having an account at the Fed. And things like that. So somewhere along that spectrum, you're definitely affecting the risk and possibly reducing the risk within the banking system. Now you're introducing a whole lot of other ingredients as well. So it's complicated, but I think you're right that the discussion about and the evolution of central bank digital currencies, will definitely play into this conversation about the amount of risk we are willing to take in the commercial banking system.
Okay, great. And I know you're working on an upcoming book on just this topic. So we really look forward to kind of, deepening this conversation at some other time. But Professor Holden, thank you so much for joining us and walking us through some of the thoughts and economics of this situation.
Thanks, Randy. Great to be with you.